Welcome to the Deep Dive, an essential conversation designed to give you a shortcut to financial mastery.
That's right.
We're diving into a crucial set of source material today that really promises to transform the way managers look at numbers.
It does. I mean, we're aiming this deep dive squarely at the learner, that's you, someone who needs to get informed and get informed quickly without getting bogged down in all the jargon.
Right. The goal is to turn those complex spreadsheets into something clear, into actionable business stories.
Exactly. We want to equip you with genuine financial literacy no matter what department you're in. This is about mastery, not just definitions.
Okay, so I think we should start with the official introduction for our source material.
Agreed. Let's set the stage.
Welcome to Core Concept HQ, where big ideas are simplified. Today, we're breaking down financial intelligence, a manager's guide to knowing what the numbers really mean. A practical guide that helps managers understand the real stories behind business numbers.
And this deep dive is based on that foundational work by Berman and Joe Knight. They founded the Business Literacy Institute, and their philosophy is, I think, really key for managers.
What's the core of it?
They don't want to turn you into an accountant. They just want everyone to become financially fluent. And it's not some innate gift. It's a learnable skill set.
I really like that framing. It's not wizardry, it's just practical knowledge. So today we're covering everything from the 3 core financial statements, which are the building blocks,
Right.
to how estimates turn finance into what the authors call an art form, and then finally the key ratios you need to make smarter, faster decisions.
Let's dive in. To start, let's really establish what financial intelligence, or FI, is. The authors define it not as a single skill, but as a set of 4 distinct learnable skill sets.
Okay, 4 pillars. Let's walk through them. What's the first one?
The first pillar is understanding the foundation. This is the bedrock. It means you have to grasp the basics of financial measurement, how to read the income statement, the balance sheet, and maybe most critically, the cash flow statement.
It's the literacy component. You've got to know the language.
Precisely. You have to internalize that crucial difference between reported profit and actual cash.
Okay, pillar 1 is the foundation. What's number 2?
Number 2 is understanding the art. And this is where it gets interesting because it moves beyond pure math.
The art.
Yeah, it's recognizing that finance is not a black and white science. It's a reflection of reality. And it relies heavily on rules, estimates, assumptions, and, human judgment.
So a financially intelligent manager knows where that judgment has been applied.
Yes, and knows where to question and challenge the numbers. That's the key.
That immediately sounds like where the real strategic power lies. Seeing the gray area, not just the black ink. What's the third skill set?
The third is understanding analysis. So this moves you from just reading the statements to actively using the information.
Okay, so this is about ratios and things like ROI.
Exactly. You're using those tools to really inform strategic decisions, whether it's about hiring someone, buying equipment, or prioritizing a project.
And the final, most actionable skill set.
That's using the information in your job, the application phase.
Right.
It means you're actively driving improvement. You're analyzing departmental cash flow, making informed cases for capital projects, and you're really assessing your company's results. The authors insist your job actually becomes more fun when you're an active participant.
So let me ask the question for everyone who isn't a finance professional. Why is this so critical? Why can't I just trust the reports from the accounting department?
Because if you don't speak the language, you can't influence the strategic direction. It's that simple. Financial intelligence helps everyone understand how success is measured in the organization. This leads to, better alignment, better communication.
Because everyone's using the same metrics.
Yes. And ultimately, much better job performance. Managers without this skill set, they get relegated to the sidelines. They can't participate in the conversations about resources because those conversations are always driven by the numbers.
It makes perfect sense. If you can't interrogate the data, you can't influence the strategy. And that leads us right into that second pillar you mentioned, finance as an art, not just a science.
It is the crucial understanding. Accounting documents are sophisticated reflections of reality, but they are not reality itself.
Why not?
Because accountants have to rely on rules, sure, but also on significant estimates and sometimes very subjective assumptions to quantify things that are, hard to measure, like the real lifespan of a giant piece of machinery.
So those crisp, clean numbers on a spreadsheet aren't absolute truth. They carry the bias and the judgment of the person who compiled them.
Exactly. And a financially intelligent manager has to be prepared to question those numbers, to see where the art has been applied. Let's look at a few specific examples of where this judgment really changes the numbers.
Okay, let's start with the big one, the one that's notorious for artistry, revenue recognition.
Right, revenue recognition is all about when a sale is officially counted. The fundamental rule here is the matching principle.
Okay.
Revenue should be recorded or recognized when the product or service is delivered to the customer.
Not when the contract is signed or, and this is key, not when the bill is finally paid.
Correct. But implementing this rule requires huge assumptions. Think about a company installing a software system that takes 2 years. When is that revenue actually earned?
Right. Is it at milestones, a percentage of completion?
Exactly. Accountants have to make those calls.
Hmm.
And this discretion is what the SEC watches like a hawk. A 2007 Deloitte study found that 41% of SEC fraud cases involved revenue recognition violations.
Wow, 41%. Nearly half of all major financial fraud is tied to manipulating the top line.
The Vitesse Semiconductor case is a perfect example of this.
What did they do?
They ran a scheme called channel stuffing. They improperly recorded revenue on product they shipped to distributors, even though they knew it hadn't actually been sold to a real customer yet.
How did they get away with booking the revenue so early?
Secret side letters and oral agreements. They basically told the distributors they had an unconditional right to return the goods later.
Which, under accounting rules, means you can't recognize the revenue.
Precisely. But they just ignored those side deals, booked the sales to hit their quarterly targets, and created this massive, temporary illusion of success.
That's a perfect illustration of short-term pressure just overpowering basic ethics.
It is. Okay, a second major area of discretion is distinguishing between capital expenditure, or CapEx, and operating expenditure, OpEx.
This is a classic one. So OpEx is something like rent or salaries, and it hits your profit immediately.
That's right. It reduces profit in the current period. But CapEx, a capital expenditure, is for a long-term asset, like a building. Its cost gets spread over several years through depreciation.
Which means your profit looks better in the short term.
It temporarily boosts reported profit, yes.
The temptation there is obvious. If I can call something CapEx instead of OpEx, my department's numbers look better this quarter.
The temptation is immense, and this exact thinking led to the infamous collapse of WorldCom.
The textbook example. What exactly did they classify as CapEx that shouldn't have been?
They had to buy capacity from other phone companies. These were called line costs, billions of dollars in fees.
And those sound like a classic operating expense, a monthly bill.
They are. But WorldCom CFO instructed them to classify these line costs as capital expenditures. They claimed they were investments in future infrastructure.
So instead of deducting billions from revenue right away, they treated them like long-term assets.
And those enormous expenses just vanished from the income statement. Profits shot up by billions overnight. It was a massive systemic illusion, and it all came down to a judgment call, a fraudulent one, between OpEx and CapEx.
Okay, and the third example of this, Art. Depreciation discretion. This sounds a bit dry.
It sounds dry, but it's incredibly powerful. Depreciation is just how accountants allocate the cost of an asset over its estimated useful life. The key word there is estimated.
So if I'm a manager and I say our new delivery trucks will last 12 years instead of 8, my annual depreciation expense goes down and my profit goes up.
That is the direct lever. A longer estimated life means a lower annual charge. And the most shocking example of this comes from Waste Management, Inc.
What do they do?
Well, they were under intense pressure to hit earnings targets. And they owned a massive asset base, 20,000 garbage trucks, millions of dumpsters.
Right.
These assets were normally depreciated over 8 to 10 years.
So their accountants just changed the estimate.
The executives ordered them to. They extended the depreciation schedules for trucks to 12, 13, even 14 years. They did the same for the dumpsters. By just fiddling with that single non-cash expense estimate, they artificially inflated their pre-tax earnings by over $700 million.
It is genuinely incredible that an assumption about how long a garbage truck lasts can be leveraged into a scandal worth hundreds of millions of dollars.
It highlights the key takeaway here. A financially intelligent manager understands these are levers. You need to know when to ask, is that estimate reasonable, or are we just trying to make the numbers look good?
Okay, let's transition to that first pillar of the foundation, the income statement, also called the P&L, or profit and loss. This is what most managers focus on.
It is. The income statement is essentially the report card for a specific period of time, a month, a quarter, a year. It tracks revenues, expenses, and the profit that results.
And the key concept here is that matching principle we mentioned.
Exactly. You have to match the cost you incurred to the revenues you earned in that same period. But, and this is so critical to remember, for most businesses, this statement is measuring sales and costs, not actual cash coming in or going out.
So when I see revenue at the top of that P&L, I should really think of it as promises received because the money might not be in the bank yet.
That is the essential contrast, and we'll hit it hard when we get to the cash flow statement. For now, just remember that the profit number is fundamentally an estimate.
Okay, let's walk down the statement and look at the three forms of profit because each one tells a different story.
The first and most foundational is gross profit. That's simply your sales minus your cost of goods sold, or COGS.
And this number tells you if your basic product is even viable, right? Before you factor in all the overhead.
Precisely. It's the basic unit profitability. If your gross profit is too thin, the whole business model might be flawed.
Okay, so after gross profit, we deduct operating expenses. That gets us to the second type of profit.
Operating profit, or EBIT earnings before interest and taxes.
Yeah, right.
This is your gross profit minus all your operating expenses, things like selling and admin costs, R&D, and that non-cash charge, depreciation.
And Wall Street loves this number, right?
They do, because it shows the profit from just running the day-to-day business before you account for financing decisions or taxes. It's seen as a true measure of core managerial effectiveness.
And then finally, we get to the one everyone talks about, net profit or the bottom line.
Net profit is what's left after you subtract interest, taxes, and any one-time charges. This is the number used for key investor metrics like earnings per share.
And because it's the number everyone is trying to hit, it's obviously susceptible to some manipulation. You mentioned restructuring charges earlier. How does that work?
So these are estimates for future costs tied to big overhauls like layoffs or closing a factory. A new CEO often takes a big restructuring charge right away to clean the slate and blame bad results on the old regime.
Okay, but the problem is in the estimate itself.
The problem is entirely in the estimate.
How does an estimate of a future cost let you manipulate profit later on?
Well, if the management team intentionally makes that initial estimate too high, they create a big buffer. Then, if the actual costs come in lower, which they often do, the difference has to be reversed in a later period.
Ah, so they take a huge hit now, which everyone expects from a new CEO. But then they get to add that overestimated portion back to their profit in a future quarter, making them look like heroes.
Exactly. It's classic earnings management. It's a trick often associated with Chainsaw Al Dunlap at Sunbeam. He basically used these overestimated charges to pump up earnings right before they tried to sell the company at an inflated price. For a manager, seeing frequent one-time charges should always be a huge yellow flag.
Okay, so if the income statement is a video of performance over time, the balance sheet is the snapshot. This is the second pillar of that foundation.
That's a great analogy. The balance sheet shows the company's financial situation at one specific point in time. And its structure is all dictated by one simple equation: assets, liabilities, plus owner's equity.
And it has to balance, always. Every single transaction affects both sides.
It must. The balance sheet is really answering two questions at once. What does the company own its assets, and how did it pay for them? Either by borrowing liabilities or through investment in profits equity.
Let's start on the asset side. First up, current assets.
These are things expected to turn into cash within a year. So you have actual cash in the bank, accounts receivable, or AR, which is money owed by customers.
And is itself an estimate because you have to guess how much of it you'll never collect?
Exactly. And then you have inventory. For managers, inventory is basically just frozen cash.
Right. Then we have the big ticket items, long-term assets like property, plant, and equipment, or PPE.
And PPE is valued using historical cost.
Yeah.
It's recorded at what you originally paid for it minus all the depreciation you've taken over the years.
This is what creates those weird situations, right? Where a piece of land bought 30 years ago for $500,000 is still on the books at that price, even if it's worth millions today.
Exactly. The book value is almost never the true market value. It's a very conservative baseline.
Okay, what about the most controversial asset? Goodwill. This only shows up during an acquisition, right?
Right. Goodwill is the extra amount you pay over the fair value of the tangible assets you're buying.
So if I buy a competitor for $5 million, but their buildings and equipment are only worth $2 million.
The other $3 million is goodwill. It represents the value of their brand name, their customer list, all those intangible things.
And the accounting for goodwill has changed a lot, which has huge strategic implications.
It has. Historically, you had to amortize goodwill, which was a drag on your reported earnings every single year. But the rules changed. Now, goodwill isn't automatically amortized. It's only reduced if it's deemed impaired.
And the consequence of not having that automatic reduction in profit every year.
It made big acquisitions much more attractive. The premium you paid didn't automatically punish your future earnings, which directly leads to higher net income and higher owner's equity.
That's a fascinating look at how a rule change can drive real-world behavior. Okay, let's flip to the other side of the equation, liabilities. What the company owes.
Liabilities are also split into current and long-term, but the one that often confuses people is deferred revenue.
Right. Why is money you've already received for a service you haven't delivered yet a liability? It feels like a good thing.
It feels counterintuitive, but it makes perfect sense. If a customer pays you for an annual software subscription upfront, you owe them that year of service.
So until you deliver it, it's a liability on your books.
Exactly. It's a great reminder that getting cash isn't the same as earning revenue.
And finally, that brings us to owner's equity, the net worth of the company.
Equity is what's left over assets minus liabilities. It's what the shareholders own. It includes the capital they invested, plus a critical component, retained earnings.
And retained earnings are just all the profits the company has ever made, minus any dividends it paid out.
Correct. And this is the critical link between the two statements.
The net profit from the income statement, where does it go?
It flows directly into retained earnings on the balance sheet, which increases owner's equity.
So if a company reports $25 million in net profit, its owner's equity on the balance sheet goes up by $25 million.
Exactly. But, and this is the vital point that leads us to the third statement, that does not mean the company has $25 million more in cash. That profit might be tied up in accounts receivable or spent on inventory. The company is profitable on paper.
But could be totally cash poor in reality.
And that fundamental problem is why the cash flow statement exists.
So if the income statement is the estimate and the balance sheet is the snapshot, the cash flow statement is the reality check. This is the truth teller.
It really is. The fundamental issue is that profit is based on accrual accounting and all those estimates we talked about, while cash is tangible, verifiable, cold, hard currency.
The mismatch is all about timing.
All about timing. You book revenue when you make the sale, but the cash might not show up for weeks or months. And this is what causes successful, profitable companies to go bankrupt.
Let's talk through that classic example, the Sweet Dreams Bakery anecdote.
Right. Sweet Dreams Bakery looked great on paper. Sales were booming. They were showing a nice net profit on their income statement.
But they had a cash flow problem.
A huge one. They paid their suppliers within 30 days, but their big grocery store customers took 60 days to pay them.
So as sales grew, they had to spend more and more cash on ingredients and staff, but they had to wait 2 full months to get paid for those sales.
Exactly. So despite being profitable, their cash balance was going down every single month. Every new sale actually made their cash situation worse. This is how a profitable business can fail. It runs out of cash paying for its own success.
That is a terrifying reality. You can be successful and bankrupt at the same time?
What about the flip side? Being cash rich, but unprofitable?
Yeah.
The fine apparel store.
Fine Apparel was losing money every month. Their rent and staffing costs were just too high.
But their bank account was growing. How?
2 things. First, it was a cash business customers paid immediately. And second, they strategically delayed paying their own vendors for 30 days.
So that immediate cash inflow plus the delayed cash outflow created this temporary cash buffer. Yes. Their bank balance shot up, even while their income statement was bleeding red ink. This gives a really dangerous false sense of security. Eventually, being unprofitable will eat up that cash buffer. It proves you need both. One without the other is a recipe for failure.
Which is why we need the cash flow statement to see the true picture. So how is it structured?
It strips out all the art and just shows the movement of money, divided into 3 categories.
The first one is cash flow from operating activities, or CFO.
CFO is the cash generated by the core day-to-day business. This is the single most important number. If a company can't consistently generate positive CFO, the business model is flawed no matter what the P&L says.
Okay. Second is cash flow from investing activities, or CFI.
CFI is cash used for buying or selling long-term assets, CapEx. If this number is a big negative, it usually means the company is investing heavily in its future.
And third is cash flow from financing activities, CFF.
CFF is cash from debt taking out or repaying loans and transactions with owners, like selling stock or paying dividends.
Now for the trickiest part. Understanding how cash flow is calculated. Specifically, how we get from net profit back to cash from operations.
Right, the indirect method. It starts with net profit from the income statement, and then you make two kinds of adjustments.
First, the easy one, non-cash item.
The non-cash adjustment, you have to add back charges like depreciation and amortization,
Why?
because those charges reduced your net profit, but no cash actually left the building in this period. The cash was spent years ago when you bought the asset. So to get to cash, you have to add that paper expense back in.
Okay, that makes sense. Now for the complex part, the working capital adjustments from the balance sheet.
This is where you see the impact of that timing difference. There are two simple, if counterintuitive, rules.
Okay, what's rule one?
Rule one, if an asset increases, like your accounts receivable or inventory goes up, cash decreases. So you have to subtract that increase from your net profit,
Wait, why does cash go down?
because your cash is now tied up in that asset. If your AR goes up, it means more of your profit is just a promise from a customer. It's not actually cash in your bank.
Got it. Okay, what's rule number two?
Rule two, if a liability increases, like your accounts payable goes up, cash increases. So you add that increase to net profit.
Let me be the devil's advocate. So if my accounts payable goes up by $50 million, my cash from operations improves by $50 million. I look healthier just because I'm paying my vendors more slowly.
You have grasped the core logic perfectly. That is a source of temporary cash for the business. It's a delayed outflow. But a financially intelligent manager knows that's not a real operational improvement. It's a financing decision that comes with risks.
In the book sample company, net profit was $248 million, but after all these adjustments, cash from operations was almost $500 million.
That difference highlights the huge managerial impact of working capital. In that example, they did an excellent job managing their assets and liabilities, resulting in a CFO that was nearly double their net profit. That is the true sign of health, the ability to generate the cash that actually fuels the business. Okay, so we had the three statements. Now we move to the third skill set, analysis. This means using ratios to put context around those raw numbers.
Right, because $10 million in profit is meaningless without context. Ratios standardize the numbers and expose the relationships between them.
Exactly. Ratios inform decisions, they help you spot dangerous trend lines, and they let you compare yourself to your competitors.
The famous example of this is how an analyst spotted the fraud at Sunbeam under Chainsaw Al Dunlap.
Yes, Dunlap was faking sales figures. The revenue on the P&L looked great, but a sharp analyst noticed that Sunbeam's days sales outstanding, or DSO, was spiking.
They were taking way longer than normal to collect their cash.
And that single ratio was the warning flag. It signaled that the recorded sales weren't turning into real cash. They were just promises.
So let's talk about the key ratios. Let's start with liquidity ratios. Can we pay our bills?
The standard measure is the current ratio. Current assets divided by current liabilities. Generally, you want it to be greater than 1.
But current assets includes inventory, which isn't always easy to turn into cash, so there's a tougher test.
That's the quick ratio, or asset test. It's your current assets minus inventory, divided by current liabilities. It's a much more conservative look at your ability to meet your short-term debts.
Okay, moving beyond just paying the bills, let's look at efficiency ratios. This gets to the heart of operations.
These are crucial because they tie directly back to a manager's performance. For example, days in inventory, or DII, measures how efficiently you're turning materials into sales,
A lower DII means your cash is frozen for less time.
which immediately improves your cash flow.
And the counterpoint to that is days sales outstanding, or DSO.
DSO measures the average time it takes you to collect cash from customers. We saw with the sample company that reducing DSO by just 1 day could free up over $24 million in cash.
An immense managerial lever.
It is. And the last efficiency ratio is days payable outstanding, or DPO.
This is how long you take to pay your own vendors.
Right. Increasing your DPO helps your cash flow because you're using your vendor's money for longer, but there's a clear trade-off. Push it too far, and you damage those relationships.
It's a delicate balance. Okay, so that's efficiency. How do investors look at the company? What are the key investor ratios?
Investors watch a lot, but the two big return metrics are foundational.
Let's start with return on assets, or ROA.
ROA is your net profit divided by your total assets. It measures how efficiently you're using all your stuff, your buildings, your equipment, everything to generate a profit.
And the ultimate measure for shareholders, return on equity, ROE.
ROE is net profit divided by shareholders' equity. This is the key metric for investors because it shows the return they're getting on their capital compared to, say, a risk-free treasury bond.
Right. If your ROE is high, you're creating value.
You're creating value.
Okay, let's switch gears to making future decisions. Smarter capital investment decisions. This is about ROI.
Correct. The best method for analyzing big projects, like building a new factory, is net present value, or NPV.
And NPV basically tells you what all the future cash flows from that project are worth in today's money, right?
Exactly. It discounts those future cash flows by the company's required rate of return, and then you subtract the initial cost.
And the rule is simple.
If the NPV is positive, do the project. It increases shareholder value. If it's negative, reject it. It destroys value.
But like everything else, there's a ton of art baked into this. Where's the subjectivity?
The whole analysis hangs on two huge estimates. First, the projected future cash flows, which managers are notoriously optimistic about.
And second?
The chosen hurdle rate, or discount rate. If you want a project to pass, you can just use a lower rate, which makes the future cash flows look more valuable today.
So it all comes down to the assumptions you feed the model. A financially intelligent manager needs to challenge those assumptions.
Vigorously, to make sure the project delivers real value, not just justified spending.
That brings us to the final piece that ties it all together. Managing working capital and the cash conversion cycle.
Working capital is just current assets minus current liabilities. It's the resources you need to run the business day to day. And the ultimate metric that links all of this together is the cash conversion cycle, or CCC.
And the formula is days sales outstanding plus days in inventory minus days payable outstanding.
Correct. The CCC measures in days how long your company's cash is tied up in the operating cycle, from paying for your materials to getting paid by your customer.
And a shorter cycle is always better.
Always. It means you get your cash back faster. This is the ultimate operational target. This is where every manager, no matter their department, has a direct measurable impact.
Absolutely. If you reduce your inventory days or your collection days, you directly reduce the CCC, which frees up huge amounts of cash for the business.
That's it. Improving the CCC is the same as unlocking the operational cash flow of the business.
You know, what really stands out to me in this whole deep dive is that financial intelligence isn't about memorizing formulas. It's really about understanding where the judgments and the estimates are hidden in the numbers and how those judgments affect big strategic decisions about profit and, more importantly, about cash. It really demystifies the entire thing.
By knowing this language, you gain the confidence, the financial intelligence, to actually question the data, to spot the biases, and to focus your efforts where they'll have the biggest impact.
Right.
Whether that's improving your department's DSO or analyzing the ROI on the next big project, you move from just being informed to being a real strategic player in the business.
Thanks for listening to Core Concept HQ, where we turn complex concepts into simple insights. Subscribe for more summaries that help you learn faster and think smarter.